So we just got the April jobs report in. It was terrible.
Terrible.
I'm going to tell you why. That's the best news that stocks could have gotten.
And now for more on today's jobs report. It was, of course, Steve, a big miss from consensus. I guess Carl had said earlier, 23 years big.
Yeah, one of the biggest in memory, David. And you try to think of a big miss. I mean, the ball was like here, the bat was down there. A lot of head scratching going on as the number not only missed the consensus by one of the largest amounts in memory.
So stocks are at all-time highs. Everything's going really well. The economy is making a huge comeback. Every data piece we get points to an economic recovery happening more quickly than we anticipated. The problem with that is that stocks have already priced that in. Everything's at highs. We've seen these crazy runs in the cyclical names, the reopening names, all that. And we've seen the tech and the growth stocks pretty much crushed in this. So now that we got this April jobs report that was so terrible, 20 years terrible, whatever the number was, now the Fed has no choice but to continue to pump money into the system and pump money into the market and buy 80 billion in treasury bonds. All those things they're doing, they're forced to continue because they're not seeing that recovery happen as quickly as possible. So now the Fed has no choice but to delay raising interest rates, which should allow the tech stocks and the growth stocks to make a comeback because investors will keep that appetite for risk if interest rates, remain near zero. Simple as that.